So, picture this. It's a Tuesday evening, you're sitting on the couch, and you're scrolling through your brokerage app. A certain stock catches your eye. Maybe it's a company that just seems to keep going up, maybe a friend won't stop talking about it at dinner, or maybe it's literally all over the financial news. You sit there looking at the glowing screen, and you think to yourself, should I finally buy this? It's a highly relatable situation. Most of us have been there as we try to manage our money and build a stable life for ourselves. But here is the thing that almost nobody tells you. The question you're asking yourself right in that moment, it's actually the wrong question. Hello everyone, I'm Taylor Reed and welcome to Dollar Playbook. Today we've got a fascinating explainer that is going to completely change how you look at the stock market.
Now, when we're looking at a stock, we usually ask ourselves things like, well, is it a good company or is the chart going up? But honestly, whether it's a quote-unquote good company barely matters for this specific decision. What actually matters is one single specific number, and it's a number that you have almost certainly never run. It is the exact growth rate that a stock's current price is quietly demanding from the company underneath it. If the company hits that number, you make money. If it doesn't, you don't. It's really that simple. So today, I'm going to show you exactly how to find that number on literally any stock.
Okay, so here's our roadmap for this explainer. First, we'll look at the wrong stock question. 2, the flaw with PE ratios. 3, the implied growth rate. 4, testing 4 famous stocks. 5, why the system hides it. And 6, how to make this your new habit. Let's dive right into section 1, the wrong stock question. When you're trying to build long-term wealth, focusing heavily on a stock's recent chart or how popular it is completely misses the point. It distracts us from what a stock price actually represents. So let's slow down for a second. When you look at a stock price on your phone, say it's $120 a share, your brain naturally treats that as a concrete fact. The price is just the price, right? Well, no. That number isn't a fact. It's a contract. It's a specific, highly measurable contract between the company and everyone who owns the stock. This contract states that the company is going to grow by a very specific amount over time to justify the risk you're taking compared to just leaving your money in a boring, safe index fund. Every single share price is silently making that exact statement, but nobody ever translates it for you. Which brings us to section 2, the flaw with PE ratios. Now, I know what you might be thinking. Wait a minute, Taylor Reed, isn't this exactly what the price to earnings or PE ratio is supposed to tell me? Let's clear that up right now. The PE ratio isn't entirely useless, but it is enormously oversold. A PE ratio simply takes today's price and divides it by last year's earnings. And that right there brilliantly illustrates the whole problem. PE is merely a snapshot of the past. It tells you what people are paying today relative to what the company already did. Imagine a mature, slow-growing business and a young, rapidly expanding business. If they both have a PE of 40, traditional finance sites will call them both expensive. But guys, they do not live in the same future. For the mature company, a PE of 40 requires an absolute miracle. For the young company, it might actually be perfectly reasonable. PE is looking backward. We desperately need a tool that looks forward.
And that takes us to section 3, the implied growth rate.
This is the translation we've been looking for. The implied growth rate calculates the exact growth a company needs to deliver just to break even against a lazy default 10% index fund. So, how do we actually find this magic number? Well, it requires exactly 5 plain inputs that anyone can find or estimate. Number 1, the market capitalization today. That's just the total price tag of the company. Number 2, the trailing 12-month revenue, meaning the total sales over the last year. Number 3, a target return. We use 10% because that's what a plain index fund historically returns over long periods. Number 4, a time horizon. We'll use 10 years, long enough to let the business play out, but short enough to be realistic. And number 5, an end state assumption, meaning 10 years from now as a fully mature business, what multiple of its sales will the market happily pay? Maybe 8 times for a great tech company or 1.5 for retail.
Let me show you how approachable this arithmetic actually is with a really simple example. Suppose a company is worth $100 billion today, with $20 billion in revenue, and we expect it to mature at 5 times sales. To get our 10% return, that $100 billion market cap needs to grow to $250 billion in 10 years. If we divide that future $250 billion by our multiple of 5, we see the company absolutely must generate $50 billion in revenue a decade from now. Going from $20 billion to $50 billion over 10 years requires a 9.5% annual growth rate, and that's the whole shebang. That is the number the price is silently demanding. No complicated charts, no guesswork, just practical, straightforward math. All right, let's move to Section 4, Testing 4 Famous Stocks. Let's see what happens when we apply this to the real world. We're going to stress test this exact framework on 4 very famous stocks to see what the math actually says. First up is NVIDIA. Obviously, it has a massive market value right now, riding the wave of artificial intelligence. But notice the sheer scale required here. If we run our 5 numbers with a highly generous tech exit multiple, to justify its current price, NVIDIA needs to grow its revenue by about 20% a year every single year for 10 straight years. Because NVIDIA's base is already so huge, hitting that 20% growth means their revenue would need to reach $1.6 trillion in 10 years. Let me put that into perspective for you. That is roughly 4 times the current revenue of Apple. No company at this scale has ever sustained that pace for a full decade. The price isn't just asking NVIDIA to be great, it's asking it to literally become the largest revenue-producing company in human history. Next up is Tesla. Giving them a very generous multiple as a tech auto energy hybrid, the math shows Tesla needs to grow revenue at about 29% a year for 10 consecutive years. But look at reality for a second. Over the last 12 months, revenue has been roughly flat, recently ticking up to about 16%. That is roughly half of what the price is currently demanding. For Tesla to justify today's price, its revenue in 10 years would need to be around $1.3 trillion. Again, for perspective, they would need to do nearly double what Walmart does today. Remember, we aren't asking if Tesla is a good company, we are asking if the price is demanding something mathematically realistic. Now let's flip to a completely different personality, Johnson & Johnson. This is the classic, boring, highly reliable, safe stock. People put this in their retirement portfolios precisely because it's so steady. But when we run the number, the implied growth rate requires J&J to grow at 12% a year for 10 years. And here is the trap. Their actual revenue growth over the past decade has averaged closer to 5 or 6%. The market price is silently asking this massive, very mature company to double its long-term historical growth rate and maintain it for a whole decade. So this so-called safe stock, it's quietly stretched. Finally, let's look at Costco. By traditional metrics, Costco looks wildly expensive. It currently trades at a PE ratio of 49. Honestly, if you only looked at PE, you would probably run away. But let's run our number. Using a reasonable retail multiple, the implied growth rate demands Costco grow at about 10% a year for 10 years. Now look at what Costco is actually doing right now. Their revenue growth over the last 12 months is between 9 and 12%. The math aligns perfectly. The number the price is asking for is exactly the number the company is currently delivering. So, the crucial point we need to take away here is really pretty simple. We applied the exact same plain arithmetic to 4 very different companies, and we got 4 distinct verdicts. NVIDIA is growing incredibly fast, but needs to become a historical anomaly to justify the price. Tesla needs to become 2 Walmarts, while its current growth lags behind the requirement. J&J, the supposed safe bet, is stretched far beyond its historical norm. And Costco, which looks super expensive on paper, is actually perfectly fair and mathematically aligned. This right here is exactly why you absolutely must run the number. Moving on to Section 5. Why the system hides it. Now, you might be wondering, if this arithmetic is so straightforward and so incredibly vital to protecting your hard-earned money, why isn't it on the front page of every finance app? Well, the answer is all about incentives. Brokerage apps, financial media, and Wall Street analysts aren't paid to slow you down. The apps get paid when you trade. The media gets paid when you watch sensational headlines about a stock jumping 20%. Analysts often just reverse engineer their price targets to validate whatever the current prices happen to be. As the saying goes, the whole machine rewards motion. And motion requires you to keep clicking buy based on headlines without ever stopping to do practical risk assessment math. You can't see what nobody shows you. And finally, Section 6. Make this your new habit. I want to be super clear here. This framework is not meant to make you a pessimist who never buys individual stocks. It isn't inherently bullish or bearish. It is simply a reliable translator. What I want is for you to make running these steps a permanent habit before you ever invest your money. Pull up the market cap and the revenue. Apply your sensible 10% target and a 10-year horizon. Estimate a reasonable mature exit multiple for that industry. Calculate the required growth rate. And most importantly, compare that rate to the reality of the business today. Take 5 minutes to run this process. It is a total game changer. Once you have that implied growth rate translated right in front of you, you are left with one honest, ultimate question. Do I genuinely believe this company can deliver this? If the answer is yes, you proceed with confidence. If the answer is no, you walk away, and you save yourself from a very costly mistake. Run the number first, decide second. That order matters more than almost anything else you'll do as an investor. Thank you so much for joining me today. I really hope this explainer helps bring some calm and clarity to your financial journey. If you found this valuable, please gently tap that like button, share this with a friend who might need it, and subscribe to Dollar Playbook for more practical, everyday financial lessons. I'm Taylor Reed, and I'll see you in the next explainer.